What image comes to mind when you hear the words private equity? Do you think of savvy investors on Wall Street? Do you think of corporate titans or folks that are just trying to cut jobs and maximize profits? Well, there's a lot of confusion around private equity and how it relates to venture capital, if they're the same or different. I'll be honest with you, I had some of those questions myself, but after being in the industry for over 15 years, I feel like I finally have a pretty good grasp on what private equity is. I took a roundabout path to get here, working in private equity-backed manufacturers, in consulting and investment banking. But again, through all those deal experiences and whatnot, got me to the point where, I'm, running 4 pillars and we're doing deals. In its simplest form, a private equity firm is a company that invests in the equity of private companies. As opposed to Apple or whoever that are publicly traded, private equity firms invest in much smaller companies that aren't large enough to be able to go public. Now, a lot of folks compare private equity to venture capital, or perhaps even confuse the two. First off, one of the most important distinctions between the two is the stage of company. Venture capital is early stage, startups. These companies are going to have negative cash flow. They might only have a few customers even. Contrasting that with private equity, where they're investing in mature, a lot of people say boring companies. These companies have been around for 20 or 30 years. They might be still run by the founder, or it might be a second or third generation family member. There's been periods of high growth in the company, most likely. However, it's also fairly common for the growth as of late to be relatively slow or perhaps even non-existent. Another similarity is that venture capital and private equity firms are both going to be aggressive about pursuing growth. Growth is definitely going to be different, though, in terms of how they pursue it. If you think about venture capital and startups and whatnot, generally speaking, all of the growth is going to come from organic growth, meaning they're going to grow their sales internally. Contrast that with private equity, where sometimes the goal is organic growth, but a lot of times for a private equity-backed company to really grow, a lot of that growth is going to come through M&A. This might be what people consider a buy and build strategy or consolidation strategy. Not to say that there won't be organic growth that's pursued. It's just in terms of what private equity is typically after, in terms of how quickly they want to grow, many times M&A is much quicker than trying to pursue an organic growth story. On the private equity side, there typically will be operational improvement initiatives. So, think about that as, maybe you buy the company with a 15% profit margin, you can try and grow that to, 16.5, or maybe if you're lucky, even 18%. Those certainly are big ways that you can increase value. But in terms of top line growth, again, it's the M&A and to a lesser degree, organic. In terms of industries, most people associate venture capital with tech. That's not to say it's only tech, because I know, for example, there's a local restaurant entertainment chain that has, venture capital backing, which, doesn't sound like the prototypical VC play, but they're out there. But generally speaking, private equity is going to invest in all sorts of industries. As it relates to valuation, how much are you going to buy the company for? Or if you invest $20 million, how much of the company are you going to own? On VC, venture capital valuations are much more art than science. Now, private equity valuations, certainly there's some art to it as well, but it's a little bit more science, in my opinion, just because you're typically basing the value off of a multiple of a prior period's earnings, and then apply a multiple to it, and that would be the value. Now, there's definitely other valuation techniques like, a DCF or, precedent transactions and public company comps and whatnot. And however, when talking about value and thinking about what you think is a quote unquote fair price for the company, in my experience, it almost always comes back to a multiple of EBITDA. when you look at the actual investments, the return profiles of those investments are actually different as well. I'm not sure exactly for VC funds what their target profile or target return is, but I know for private equity firms, it's going to be at least 20% range for target return for the fund. However, when you look at the individual investments, there's a lot more variability. What I've heard about venture capital is if you make 10 investments, what you're hoping for is maybe one investment to return 10 times your money, maybe 2 or 3 or 4 to simply provide a return of capital, then the remainder would be a complete loss of capital. Private equity is totally different. If you make 10 investments, you would definitely hope that 0 of those investments result in a loss of capital. At the very least, you would want a return of capital with a modest return, let's say 5 to 10%. You don't have those loss of capital situations, but for most private equity investments, you're also not going to get a 10x return. Why do these firms exist? Well, I think you need to think about it in 2 ways. Like, why do they exist for the company that you're investing in, but also why do they exist for the investors? What role does venture capital play for early stage companies? And really, it's a lifeblood for many of those companies. I think many people have heard of the term bootstrap, which is essentially where you're just using your own money, using whatever money the company can cash flow in order to finance the business. And that can often result in very successful companies. However, with certain companies or certain startups, the goal isn't just to get to 10 or 20 million of revenue. It's to be a startup that's worth $1 billion. If you're going to try and bootstrap, the numbers would suggest that you have a much more likely chance of actually getting to those monster valuations if you have VC backing. It's primarily the capital that the VC firms provide, but it's also the experience of having been there, the networks, et cetera, et cetera. The role that private equity plays for mature companies and whatnot, it's usually a little bit different. Sometimes the companies don't even need capital. They're just, humming along, throwing off a whole bunch of cash, and they can pursue growth out of their own company's, internal cash flows. So in those circumstances, it's less about what the company needs and more about what the owners needs. Oftentimes, there is not the internal capital needed on the balance sheet in order to pursue acquisitions. So you look at private equity firms and you might say that their current strategy doesn't require any additional capital. It's not until the private equity firm actually gets in there that they need that capital. Regardless, the goal is growth, and if growth is to be achieved, whether it's VC or private equity, oftentimes that's part of the role that VC or private equity play. So when looking at private equity firms, how do they get started? But if you look at private equity firms today, what you see is that you have somebody working at private equity firm XYZ, and over the years, XYZ gets bigger and bigger. They raise subsequent funds, and maybe fund 1 is 250 million, and fund 2 is 500. And regardless, the funds keep getting bigger and bigger as time goes on, and that requires at least a slight change to strategy. Instead of pursuing $25 million transactions, now maybe they need to pursue $50 million transactions and this and that. Oftentimes what you happen is maybe Bob that works at private equity firm ABC says, this firm's really successful, but I want to go back to the roots of how we were formed and pursue those smaller transactions. I think there's a lot of value there. So even though ABC is doing great, I think I could be really successful starting private equity firm XYZ that is pretty similar to my old firm, but I've made a few tweaks to the strategy where it's going to be a smaller fund, et cetera, et cetera. So that's the very common way that private equity firms get started. That's not how we got started. For better or for worse. That's great about all those other firms. It's just, unfortunately, that's not the background that I had or my partner had. And we kind of did it the entrepreneurial way. We started a private equity firm from scratch, essentially. If you look at private equity firms these days, there is a sort of evolution. I think the earliest stage is what's called a search fund. Essentially, a search fund is where you have one individual, sometimes 2 guys working together or 2 people working together, and they want to pursue an acquisition that they will become the actual CEO of. It's actually how 4 Pillars was started. We wanted to buy 2 companies, one for me to run, one for my partner to run. And we did that. And what I would say is, after I had that experience of running a, quote unquote widget manufacturer, I realized that it was really, working on deals that got me most excited. And I didn't know what the term was at the time, but I wanted 4 pillars to grow into a private equity firm, and really what we were becoming is what's called an independent sponsor. An independent sponsor is just like a private equity firm or a private equity fund, except we don't have a committed pool of capital. Instead, we raise capital on a deal-by-deal basis. Now, the negative is there, obviously, because we don't have the capital that we can draw from. However, the good part is that we have a great deal of flexibility. I mean, we can pursue any type of deal we want, or we can abandon any deal we want. It's really up to us. I would say certainly our goal, and we're moving towards raising an institutional fund. However, we really want to take advantage of this period because we have so much flexibility, we have a lot of deals to look at, and it's a great model. Now you should have at least a little bit better view of what private equity is, but I don't want you to think private equity is boring. I mean, come on, guys. I'm the most boring guy in private equity, so I don't blame you, but private equity is not. I mean, really, I think private equity, M&A, is the most interesting part of business, but that's my own personal take. What do you guys think? Is private equity good? Is it at the very least exciting? Is it interesting? Let me know in the comments. I would love to hear from you.